All right. Thank y'all for having me. I feel so official with this on and all this. Makes me just a little nervous. I'm David Brown. I think I've met everyone here. I'm pretty sure. If not, I'm sorry. And we'll get to me. But mortgage loan officer with Sierra Pacific Mortgage. Have an office here in Johnson City and do business in 4 or 5 states. So that's who I am. And today I just wanted to be with you guys, and Happy New Year, and give you some updates on lending in 2022, some changes, some good things, some not so good things, and just some ideas to think about as you're talking to clients and as you have questions. And at the end of the day, I welcome questions, so don't ever feel like you got to wait till these kinds of meetings to get the information. So I'm a phone call or a text away from answering any questions you have, so please know that. But just a few thoughts, if this cord will let me put over here. So one thing that we hear a lot from our borrowers on is, what are rates going to do? You know, rates are going up, which means less purchasing power on a house, assuming they're financing it. You know, all the guidance we're hearing and all the indications we're hearing is we continue to be in a rising rate environment, which is really nothing new, or what seems to be new. Of course, it all got kind of real probably in the last 30 days as we're seeing a lot of news on inflation, what's going on with the bond markets, what the treasury yields doing. Yesterday it was at 1.75%, so we're down to 1.75, so that's up from where it's been. Rates tend to track the 10-year treasuries. So I think borrowers are just now seeing a material difference in, you know, where they thought rates were versus where they are now. I had someone I was going to do a refinance for a couple months ago, and the rate was going to be like 2.99. Now I'm having to tell them it's a cash out, so there's a little bit of a pricing adjustment. Now it's like a 3.5 to 3.625. So that's a big jump for someone who's borrowing, you know, $200,000 or $300,000. So I think that's a little sobering for some people, but still, I think the good news is you know, Fannie and Freddie have put out some projections on what they see rates doing this year, and I think everything I'm seeing is, you know, still in the mid threes. So, you know, all things considered, based on rates where rates have been in the past, very good interest rates, which of course, you know, will help support the market and the real estate values. So we're seeing higher rates. The average rate yesterday among lenders surveyed was just over 3.5% on a 30-year, 2.82 on a 15-year. You know, consumer price index showing inflation for 2021 was 7%. So I mean, that's helping drive a lot of this. Loan limits. Y'all have heard about the conforming loan limits going up, FHA loan limits going up. That's good news. So that borrower who needs FHA financing with 3.5% down, who has marginal credit or maybe not so great credit, now can finance up to over $420,000. So that went up from $356 and some change. So I had a borrower last year who had to go FHA. He just had to, but he wanted a $390,000 house or something. Well, he would have had to put $40,000 down, which he didn't have. Now he can get that. So that's meaningful for people in that price range. Which once upon a time that price range wasn't as prevalent as it is now. But that's inflation for you, I guess. Conforming loan limit 647.2. That went up from 548.200. So that's almost $100,000 increase before you have to go jumbo, which presents whole other issues. Those are doable loans, jumbos are, but they're not fun a lot of times with all the extra requirements. And if you have borrowers who are fortunate enough to find a duplex, triplex, or quadplex, and they want to live in one of them, those limits go way up from there. So on a conforming loan, $1.2 million and some change. 809 on a FHA if it's a fourplex. So I know there's a lot of people who would love to find a property they can live in and then turn into an investment. And if they're going to live there for at least a year, they can do that with 3.5% down. So that's on FHA. So fantastic product. Problem is finding that property that qualifies for FHA. VA loan limits, there's not technically a loan limit for VA, but the way the pricing works is if it's over the conforming loan limit, it'll be priced as a VA jumbo. We did raise our limit on that to $2 million. It was $1.5 million for VA loans. And believe it or not, there are people buying, financing that much on VA loans. So that's up as well. And let's see what else. You got any questions so far? Am I talking too loud?
No.
Loud enough?
On the FHA one, if you buy one, like I bought one, say I buy one this year, a quadplex, and do that and live in it for a year, and I move out, can I do another FHA loan after that? Or is it just like a one-time thing?
Yeah, I don't think you can have more than one FHA loan at a time.
Okay.
Yeah, but you can do it conforming with 5% down.
Okay.
Yeah, 5% down. Yeah.
Anyway.
Yeah, good question. Any others? Some big news that we just received over the last couple weeks has to do with second homes. And I don't know if y'all see many, we see some of this with people over in the mountains, Mountain City, Banner Elk, Boone, people wanting to buy second homes, Blowing Rock. I'm even working on it with the guy up on Watauga, buying a house up there. Have y'all heard about these changes on second homes at all? So this is pretty big. So if you have someone who's looking for a second home right now would be a good time to get them under contract, because any loan delivered to Fannie or Freddie after April the 1st, meaning they'd have to start the process probably early March or late February. Any loan delivered April 1 or later is going to be subject to some major additional fees on the discount points. So rates and discount points go hand in hand. If they're putting the minimum amount down on a second home, which is generally 10% on a second home, they're going to have to pay an extra 4.125% of the loan amount as part of the rate. Okay, so y'all heard of discount points. Rate comes with discount points, or you could do the rate at par, which means no discount points. So let's say today, if a rate on a second home is 3.625 at par, meaning no discount points, after April 1, it's 3.625, assuming rates are the same, with a 4.125 fee of the loan amount. So if it's a $300,000 loan, that's what, extra 12 grand that didn't exist now. So that's a big deal. I think what's happened with that, this is my opinion, but I think that what Fannie and Freddie have figured out is that a lot of people buying second homes over the last year or so have not truly treated them as second homes. Airbnb has become such a big thing. Verbo, they're essentially, and maybe they're occupying it some of the year, but they're essentially buying a rental property, getting great financing on it, which, who wouldn't want to do that? But now it's not really a second home. It's more, in the traditional sense, it's more of an investment property. So I think that's where it's coming from. And of course, with investment, there's a higher risk of default. So I think they're just trying to price in that risk. So if you know of anyone buying a second home, just make sure they know the changes are coming. So those are the big ones that I could think of that y'all might want to know. The USDA limits are going up too. I don't know exactly what those are for now, but they're tiered based on the number of people in the household as far as the income limits. Usually the income limits, or the income, is what dictates how much they can buy in a USDA loan. And of course there's the geographic limitations too, but those are some of the big ones. In some ways lending's been easing up, and in other ways lending has been tightening up. So it all kind of depends on what the loan program is, the nature of the purchase, and all that. So pepper me with questions. Sorry I was late too, by the way.
Questions?
I'll have one. It's not related to what you said though. Can you give us a little bit more insight into physician's loan? Do you deal with those?
Yeah. So physician loans, and some lenders will call it a professional loan if you've got a medical degree or certain professional designations, you can qualify for that. Most of the lenders that offer these programs are traditional banks and credit unions. What the biggest benefit to a physician's loan is a no down payment. And maybe being able to not look at the student loan debt as adversely as you typically would, have an account. So a lot of those are deferment, and the lender, traditionally we have to count something for that payment, which gets factored into their debt to income ratio. With the doctor programs, they may be a little more lenient on how they look at the student loan debt, which most of the times there is. I mean, sometimes there's not, but the biggest advantage is 100% financing with no PMI. Now, in the last couple of years, I've heard more and more that some of the local banks that have been the bigger players with those have backed off of 100%. Now they're now requiring maybe 10% and putting on PMI. So, and the rates are usually right in line with what everyone else gets. Lower down payment, maybe no or low PMI could be an advantage.
So the debt to income ratio would be different, I'm assuming then?
Yeah, if they're not having to count anything towards a student loan repayment, then that would help their DTI, which would let them qualify for more.
Okay.
It's a challenge I have sometimes with like residents who are still making smaller amount relative to what they will be making, but we have to factor in for what their student loan debt is. I just pre-approved someone the other day, and it's a little tight because we have to count for Freddie and FHA. We count 0.5% of their student loans. So if they have $200,000 in student loans, we have to show that they've got a $1,000 monthly payment, even though they don't have to pay it. So yeah, it can be tough sometimes with residents. And if they have a car payment and everything, it's like, well, and they're wanting to buy $700,000 house. It's like, well, and another thing to think about too is with physicians, if they have a contract, that income's got to start, where their start date's got to start 60 days, within 60 days of them closing on their house. So this guy I pre-approved the other day, he's got a contract with Ballard or whoever but it doesn't start till I think September, maybe October. And so that's great, but we can't count that now. Even though it's signed and sealed, we have to go by what the current income is. So it's kind of unfortunate, but might need to wait a little bit. Yeah, I was with True Point Bank for a few years, and I did doctor loans, and it was nice to be able to offer the program, but being a community bank, we couldn't do a 30-year fixed. It had to be an ARM, and we had to count something for that student loan. So it ended up being that we, really the physicians that we could help the best were more established, but then they didn't really need the 100%. So we didn't do a lot of it.
Okay.
So. What else? Anything? I hope my content was sufficient.
It was.
Yeah. Well, thanks all for having me. It's always good to hang out.
Thanks for coming.
You're welcome. And again, thanks for your patience with the
Oh,
film.
you're welcome. What your fault.
Well,
Thanks, David.
they gave me a discount, so.